Very good morning. Financial management, part 3. Hope you could have watched part 1 and part 2. Objectives of the session to understand the functions of financial management, to explore the roles performed by financial manager with respect to financial management. So, functions of financial management, we can have two broad classifications. Number one is decision making function, number two is managerial function. So financial manager also performs these two functions. Let us see one by one. Decision making function again subclassified into financing decisions, investment decisions, and dividend decisions. The number two, managerial functions. Forecasting financial requirements, that's number one. Number two, raising of necessary funds. Number three, negotiation of terms of financing. Number four, management of income. So we will see one by one in a detailed manner. Okay, financing decision. It refers to how the total required funds or get by the firm will be made available through financial instruments such as issue of shares and debentures. Okay, how does a company raise finance? How does a company raise fund? How money is getting into the business? That is exactly the liability side of your balance sheet. What are they? Equity share capital, preference share capital, debentures, bonds. So all these things are called financial instruments which gets money into the business. So what is the right combination of those has to be issued? What is the right combination of financial instruments are to be issued? For example, I need 100 crore capital. How much shares have to be issued? How much debentures have to be issued? And how much I need to get as a loan? So this talks about financing decisions. It includes the best capital structure of the firm. What is capital structure? Capital structure is proportion of debt and proportion of equity mix. Let us say 50% debt capital and 50% equity capital can be employed in the firm. See, there is no hard and fast rules. Depends on the nature of business, depends on the nature of product, depends on the nature of market, depends on the operations of your firm. This mixture will vary. I mean, the debt equity mix will vary. Determining optimum proportion of debt and equity capital. So optimum proportion refers to which proportion gives maximum profit, which proportion gives low cost of capital. Okay. Then deciding about borrowing policy of the company. No company runs without debt, right? 99.99% of the companies borrows money from somewhere. It may be in any form, shares, debentures, loans, whatever. Who decides the borrowing policy? And finance manager of the company, with consultation with top management, he draws the policies. So this policy says only this much finance you get for the quarter. For example, 5 crore you can get for a quarter. 20 lakh to 20 crores per annum, not exceeding 20 crores per annum, you can get as a borrowing from any bank. So without policies, organization efficiency is question mark. Try to understand. So deciding about borrowing policy of the company is coming under financing decisions. Negotiating of finance is a continuous process. Okay, whenever you get money from the banker, it is always based on negotiation skills you have. Do you think everybody is charged the same level of interest? I mean, the same percentage of interest? Let us say there are three companies ABC. Do you think every company pays 25%, 24% interest? ABC, all the companies, can you say the interest level is equal? Practically, it is not. Depends on the credit worthiness of the client. Depends on the history, the relationship. Depends on the deposits he is having at the particular bank. The interest rate will vary. Will differ from one client to another client or one company to another company. Then deciding the cost of financing risk repayment schedule. Okay, cost of financing. What is cost of financing? Cost of financing is otherwise called cost of debt. Okay, cost of financing refers to the amount the company paybacks, the amount the company returns to the investor. For example, you invest in the company in the form of equity capital. What you get is dividend. You invest in the company in the form of preference capital. What you get is preference dividend. You invest in the company in the form of debentures. What you get is interest. You invest in the company in the form of loans. What you get is interest. Clear? The cost of financing is equal to cost of debt. That is the return which you are going to give it to your investors. Investor may be in any form: shareholder, debenture holder, banker. Correct? Okay. Risk refers to any uncertainty which the business is going to face. So proper risk management technique we need to use to mitigate any unforeseen risk which may appear. Repayment schedule. So if you are getting any interest benefits, you can extend repayment period. Otherwise, you should have a shorter repayment period to save in interest. Next one is investment decision. It has to be made with regard to utilization of funds in one activity or the other. Okay, the financing activity, I source the amount, correct, through equity capital, preference capital, loans, debentures. In financing decisions or financing functions, let's say, I source the amount. But in investment decision, I'm going to invest the amount. There are a lot of investment avenues available for a company to invest and take some return. Correct? So how you are going to invest? Your investment strategy is otherwise called investment decisions or investment function. It involves the following: determining the total investment employed in the business, determining the size of investment in the permanent asset. Okay, fixed asset, how much has to be there? Because the financing decision talks about liability side, investment decision talks about asset side. Deciding about allocation of funds to each investment proposal. So it matters, for example, you are having, let us say, 100 crore rupees in hand. As a businessman, it matters what are all the business avenues you are investing in it. As much as you are investing in a diversified portfolio, that is in many investment avenues, your risk is minimized and return is maximized. Evaluating of investment in respect to risk and return. For example, you are having two investment proposals. Let us say you are having two investment proposals: Project Lemonade and Project Chocolate. So both requires, let us say, 1 lakh rupee investment. Lemonade is making lemon juices and selling it. So that requires 1 lakh rupees investment. Let us assume it's a small store which sells it. Again, the chocolate factory needs again 1 lakh rupees investment. In both the business, you get 25 percentage profit per annum. In both the business, you get 25 percentage profit per annum. Where do we invest? What is the risk involved? That you need to look. Don't look at just the investment and the return. It is same in both the business, 25%. Don't look at it always. People who always look at return, they will fail in the market. People who look at risk, they analyze the risk, they take the calculated risk, they win the market. So comparatively, in the two business, which is more riskier? The lemonade business, the lemon juice business is having more risk. Any idea why? Because it's a seasonal business. Only in summer season, the sales will boom. The rainy season, winter season, people will avoid taking lemon. Correct? But chocolate business is not like that. Across the year, you have a market. It doesn't matter which season is going on. So it is wise man decision to invest in a chocolate company instead of going for a lemon juice manufacturing one. Like this, you need to evaluate every investment proposal you get. There are many investment proposals looking very attractive, giving equal returns, but all of them are not one and the same. End of the day, you should be a successful uh, businessman. For that, you should know how to evaluate the proposal. There are many other techniques which will come in the forthcoming unit. So for theoretically, you should know it. You should analyze the risk and return. Deciding about the finance performance of each activity. For example, I'm having three business. I invested my money in three business, correct? Each business, the analysis has to be done separately so that you will know which business is highly active, which business is less active. So try to understand that. If you are investing more in lowly active business, then if that is the case, you are going to lose your money. So the business is not active or it is not up to the mark, you should look at it in terms of risk management, whether you can recover the company or not. If not, sell it off and move to other company. Decide regarding optimal capital structure. That's what we have seen in the previous slide itself, which is your debt and capital mix. Dividend policy decisions. Dividend policy decisions. These decisions are related to part of profit that will be distributed to shareholders in the form of cash dividend. The amount of profit kept back for utilization by the firm. So the amount of profit kept back by the utilization of firm is otherwise called retained earnings. The undistributed profit is called retained earnings. So you know in the balance sheet there is something called sales. Some expenditures you get gross profit, and some admin selling expenditures you get net profit. Right? From the net profit, we need to declare dividend because equity shareholders are owners of the company. After giving interest to debenture holders, after paying interest to loans, after paying the preference dividend, is anything left, equity shareholders are having full right to entitle that. So, you have to distribute dividend to your shareholders. But whether to distribute dividend or keep the dividend with the company can be decided by the board of directors. It is not mandatory for equity shareholders that they need to get dividend every year. It is not mandatory. It is optional for the company to declare dividend and give it to the shareholders. For example, every shareholder gets rupees 100 as dividend. For example, every shareholder gets rupees 100 as dividend. That's what the profit left, correct? Let us say the profit left is 1 lakh rupee. That 1 lakh rupees, let us assume there are 1000 shareholders. So 1 lakh divided by 1000 equal to rupees 100. So every shareholder's part is 100, but it is optional to the company to give 100 rupees to the shareholder. That is full dividend. Or sometime they retain 50 percentage, they give 15%, 50 percentage. I'm sorry, they retain 50 percentage, they declare 50 percentage. That is 50 rupees retained earnings and 50 rupees dividend. Sometime it may be 70, 30. That is 70 rupees retained earnings, 30 rupees dividend. It all depends on the company's decision. Right? Determining the amount of surplus to be distributed as dividend to shareholders. What is called this amount of surplus? I paid every expenditure. I have taken some amount as retained earnings. Still, it is having some amount to be paid to the shareholders. That is the surplus. After retained earnings, something left there, that is called the surplus. Retained earnings is a type of reserve you are taking for future purpose of business. For example, you are assuming that there will be economic slowdown in the next year because of political leadership change in the country. So the company is going to face it, right? It may lose some projects. So many employees will lose the job. So if that is the case, the company should not declare the dividend now. Instead of that, the company declare, let us say 20-30% of the profit as dividend, remaining they keep it as retained earnings. So if there is any huge loss or economic slowdown in the future, the company will stand and survive. Decision regarding the formulation of dividend policy. So there are many types of dividend policies that we will see in the forthcoming units. Decision regarding allocation of profit among the shareholders. So this already explained, right? Whether to allocation of profit among the shareholders or to keeping it with the company. So for preference shareholders, it is mandatory to declare dividend. But equity shareholders, it is optional. And it is mandatory to pay interest. It is mandatory to pay interest to bankers and debenture holders. That is why debenture market is always safer than your share market, practically. Because whatever happens in the market, you get the agreed interest rate, which is 8 to 10 percentage. But in share market, it is not so. The price of the share may go up and come down, highly volatile, and the dividend is not fixed on. Ascertaining shareholder desires regarding return and the tax rate, ascertaining the stock exchange quotation and the behavior of share prices. So all those things you should keep in mind while you are declaring dividend for your own company. Okay. Part 2 is managerial decisions or managerial functions. Forecasting financial requirements. It's like planning ahead. What will be the financial requirement in the near future? It is one of the important functions of financial management. It is useful to meet the payment of liabilities and to invest the funds in a profitable one for increasing the profitability or profits. Okay. What is your fund requirements? Short term, medium term, long term. That is forecasting your financial requirements. Let us say next year there may be a possibility of acquiring a new company. If you are planning for it, if that is the case, you should allocate finance now. Or you should think about how to raise the finance. Okay, you don't have the finance, but how to raise it? There are many opportunities to raise finance. Avenues: equity, debentures, preference shares, loans, venture capital, and so on. So you need to forecast your financial requirements in advance. So you need to know your payment of liabilities, how much cash flow in which month it comes. For example, January month, this much cash flow I get. February month, this much cash flow I get. Okay. So whether I will have a surplus in hand or I need to borrow because of deficit, all those things you need to decide. Raising of necessary funds. After deciding the long-term, short-term financial sources and the size of funds, the company have to involve in the process of raising of funds. That is issuing shares, issuing debentures, approaching our banker for getting the money. Negotiation of terms of financing. While raising funds for meeting short-term financial needs through the debts. Example, by way of bank credit, the firm has to negotiate the conditions for getting credit with the bank managers. This point I explained already. The interest rate is not same to all the clients. There may be some variations, 1%, 2%, even in points. Again, it is also based on their credit rating levels, credit rating ranks. So credit rating is a ranking or rating assigned to the company which shows the willingness and ability to repay the debt. It's for your knowledge sake. Credit rating is the rating or ranking assigned to the company which shows the willingness and ability to repay the loan. Management of income. Firms has to fulfill the needs of everyone based on the earnings of the company. Firms has to fulfill the needs of everyone based on the earnings of the company. Okay, what are all the needs of everyone? Supplier needs their money on time. Okay, but customer needs credit sales. Correct? They will pay after some time. Your shareholder needs the dividend, bulk dividend. They want fatty payment. Your creditor needs your interest. Your bankers, debenture holder needs your interest. Your employees are looking for their incentives and salaries on time. See, all those things happens when there is a efficient management of income received by the company. Otherwise, everything is getting delayed. But when something is getting delayed, it definitely affects your organization. For example, if you are paying dividend very late, what happens? Once they receive the dividend, they will sell the share and they will move to other company. Shareholders, I'm talking about. If you don't pay interest to the creditors on time, you are not able to raise your fresh debts. Next time when you go and ask for credit, he will not give because of late payment. If you are not paying the salary to your employees on time, their interest gets down. They will not perform as they performed earlier. Correct? So to avoid all this, efficient management of income that matters a lot. Okay. This is part 2. That is role of financial manager with respect to financial management. Record keeping that even accounts managers does, but finance manager keeps records related to finance department. Okay, so he's having a recording of all the transactions which is going to happen in the future, because the accountant records what has happened in the past. The finance guys records what is going to happen in the future. Preparation of financial statement. What is financial statement? Where income statement and the balance sheet. Income statement is nothing but your profit and loss account. Balance sheet you know very well. Administrating the receivables management. Administrating the receivables management. What is receivables management? You already sold the goods on credit. So your debtors has to pay back the amount, that is called receivable management. Clear? So when he is doing receivable management, he knows that on which period how much fund will flow inside the organization. Whether the particular month go without debt sheet or with debt sheet. Do we need to borrow or not? Or which customers paying on time, which customers paying late, follow-up calls, all those things it would be useful. Protect the firm's securities and other reserves. So it is his ability to maintain, that is the financial manager's abilities to maintain the funds safely and securely, so that the reserve will not liquidate. Maybe in the maybe ready for liquidity, but he will not liquidate. He can manage the funds. Once you liquidate, the amount will go away. For example, if your company's investment is 15 crore, what is liquidating? Selling it to somebody and getting the money and paying your debts. So instead of selling the asset, if he is able to manage, in this case, is saving the reserves. Distribute the necessary instruction to the different levels of manager, because finance is the central point of any business activity. He has to give instruction to all levels of managers. For example, every day the sales has to be 5 crore. Every month miscellaneous expenditure should not exceed 10 lakhs. Every department head is authorized, or divisional head is authorized to spend, let us say, 1 lakh rupees without any authorization from top management. So all these things are instructions passing from finance department, and the finance manager is a key position there. Okay, financial reporting. Every 3 months once, whether it is a public limited or private limited, they look at their performance. It is financial reporting. That is comparing their financial statements using common size comparative ratio analysis, fund flow, cash flow statements. They will know their strength and weakness in terms of finance. They know the uh, financial soundness of the firm by doing so. In case of public limited company, they need to report it to the public. They need to report it to the general public, because they are the investors, right? They need to know the performance of the company. Liaison with the banker. And many companies, financial manager is authorized to be a licensed person with the bankers. So he is maintaining the relationship with the bankers for getting loans. Analyzing risk versus reward. That's what we explained by using the lemonade and chocolate company example. So analyze risk versus reward. Management of cash flow into business. Example, the first quarter, for example, April, May, June, how many money will come inside and how many money will go out of the business. That is cash inflow and cash outflow is managed by the financial manager. They prioritize the expenditure. So this has to be paid off first. This has to be paid off the second. Financial planning and control. So financial control is exercised when something goes out of planning, when something goes out of budgeting. For example, food expenses in the company should be 12 lakhs per month. Assume that you are providing free meals to the employees. In a particular month, it goes to 15 lakhs. What does it mean? There is a wastage of food. Correct? Definitely. But sometimes there may be increase in price. When increase in price, you should not increase your budget. When there is an increase in price, you should not increase your budget. Worst cases you can increase. Best cases you can control over the cost of the materials you are using. For example, is one vegetable price goes up, stop buying that and buying one which is cheap. That is cost controlling strategy. Right? So control mechanism is exercised only when there is a deviation. Long-term capital investment evaluation and decisions. So whenever long-term capital investment, what is long-term capital investment? The capital invested for, let us say, more than 5 years, 10 years, etc. It is long-term capital investment evaluation and decisions. So the long term also, if your investment is not performing well, take the invested amount back by selling the asset or by selling the investment and invest in the right avenue. You can wait for its performance, that is not an issue. But we know it is not going to perform at any cost, then take back your investment. Don't worry about the interest. So this job is done by again financial manager. He decides which investment to continue, which investment to withdraw, and which investment to log in. Evaluating financial performance. That's what using their financial statements, using tools of analysis such as common size comparison, balance sheets, ratio analysis, fund flow, cash flow, etc., etc. So it is the duty of financial manager to maintain liquidity, that is to maintain certain assets in the form of cash are easily to make cash. Solvency, to pay off your debts using cash, that is solvency. Profitability, that is input of cash is less than output of cash, or output of cash is more than input of cash. For example, input of cash is your investment, output is your profit. Let us say I invest 100 rupees in a business and I get 250 rupees as output, that is the sales amount. So what is my profit? 150, because I invested 100, I get 150. What is profitability? That is 250 divided by 100 equal to 2.5 times. This profitability. Analyze the risk and return. So high risk, high return; moderate risk, moderate return; low risk, low return. For example, in personal finance, share market business, high risk, high return. Let us take mutual funds, medium risk, medium return. Bank deposits, low risk, low return. Got it? Last one is portfolio management. Okay, what is portfolio management? Managing your investment in different investment avenues. That is called portfolio management. For example, running your business, right? Running your business, you invested in somebody's business, one part, and you purchased assets, real estate, another part, and you invested in fixed deposit in the bank in the name of the company. So the portfolio has three parts now: the real estate, the gold, and the fixed deposit. This is what we call as portfolio, the combination of various investment avenues. This is what we call as portfolio. So how to manage a portfolio? If one avenue is making the loss, as I said earlier, sell off the avenue, sell off the investment in the avenue, take your amount back and invest in the new avenue or some existing avenue which gives maximum profit. Hope it was happy learning to you. Any doubts, you can reach me through my WhatsApp. Hope everybody has my number. Uh, Hope you understood functions of financial management, role of financial manager. Correct? This is what the two topics we have discussed so far. Thanks for your patience and listening. Good day.